Good morning, everybody, and a very warm welcome to all of you to the yet another, this is 22nd edition of the FICCI IBA Annual Banking Conference. The theme of this year, as known to you all, is Winning in Uncertain Times, reflecting on the current complexities. And we all know India's economy is moving ahead at a quick pace in otherwise uncertain global environment, and banking sector is exhibiting resilience. And how do we really maintain this position in a difficult global environment? This is going to be our focus of this year's FIBAC, and we're extremely honored to have amidst us Honorable Governor Mr. Shaktikant Das this morning. May I now request Mr. Shubhrakant Panda, President FICCI, and Shri A.K. Goel, Chairman IBA, to kindly felicitate Governor with a green certificate. This, as you know, sir, it's here. So this signifies our Go Green initiative. You're well acquainted with that. Thank you, sir. May I now invite Shri A.K. Goel, Chairman IBA, for the welcome address, please.
Thank you very much, Ms. Jyoti. Honorable Governor Sri Shaktikant Das ji, Sri Subrakant Panda, President FICCI, Sri Khara ji, Chairman SBI, Sri Amitabh Chaudhary, Chairman FICCI Banking Committee, Sri Saurabh Tripathi ji, MD and Senior Partner of the BCG, Sri Shailesh Pathak, Secretary General FICCI, Sunil Mehta ji, Chief Executive IBA, Ms. Jyoti Vij, Deputy Secretary FICCI, and all the participants to this conference. Very good morning and warm welcome to all of you in this N1 conference of IBA as well as of the FICCI. Before I start, I want to convey my sincere thanks to Honorable Governor Saab for accepting our invitation and grace the occasion. This joint conference of the two associations, one representing the corporate, the another representing the banking sector under the brand name of the FIBAC, is entering in its 18th year. For the IBA as well as the FICCI, it is a momentous occasion, and I am glad to note that event evinces the considerably interest among the various stakeholders. Ever since the FIBAC was conceptualized, we were quite keen to select a contemporary theme for the conference so that participants derive fresh ideas and thoughts at the end of the 2 days deliberation of the event, spanning across the relevant area connected with the overall theme of the conference. This year, the theme of the FIBAC theme is the winning in the uncertain times, which is quite relevant and significant for the 2 days contest. Uncertainty is like a weather. It is always there as a part of atmosphere and a condition over which the individual and the organization have very little control. If they are having the control also, so very minimized they can do. The severity of the uncertainty, like the severity of the weather, can rise or fall at the movement around the world. CEOs are operating under the series of the severe uncertainty alerts emanating from the geopolitical tensions, supply of the disruption, and the digital transformation. Internationally, monetary funds at the beginning of the January of this year had observed that I am quoting, the shocks that have shaken the global economy in recent years have introduced a normal for turbulence driven in some cases by political fragmentation between the countries. This episode have also lifted uncertainty to the exceptional high level, which in turn hurts the economic growth as well as research shows. Friends, today we are nearing the end of the year, and I think situation has not drastically changed so far. In the October edition of the World Economic Outlook, IMF projected the lower growth of the 3% for this year and 2.9% for the next year as a globe. Inflation, which is otherwise indicators which is closely observed by all, it is projected to come down from the 8.7% in 2022 to 7% in 2023, and it is unlikely to meet the target of the 2%, which is a target to be achieved by the 2025. It also highlights the uncertainty surrounding the world economic activity, which could worsen the growth and inflation dynamic further. Geopolitical tensions are increasing than before. These issues have economic impact either directly or indirectly across the world, as we are operating in a very highly integrated world. There is structural uncertainty, namely the disruption to many business models brought about the technology changes, the rapidly changing nature of work, devastating effects of the climate change, and shift in consumer needs and tastes. Under these circumstances, the steering the economy by the regulator and policymakers and navigating the institutions like bank to remain agile and strong are extremely important for the overall financial stability. As you all know, the uncertainty surrounding the landscape cannot be totally mitigated. However, it could be managed by the appropriate policies, actions, and the strategy to build resilience so the shocks could be absorbed and quickly recover from the setback and stay in a position to benefit from the new opportunity. I think you all will be agreed the policy measures taken by the banking regulator, that is Reserve Bank of India, either to manage the liquidity, to manage the risk, to manage the inflation in last more than 2 years, or even in the time of the COVID, the scheme floated by regulator, the OTR1, that is best in the global. And on account of this, if you see the profitability of the PSB, which used to be around 36,000 crore in 2014, has improved to more than 1 trillion in the March 2023. Similarly, the assets quality, gross NPA, the net NPA has also been significantly improved, and it is around 3% the last March 23. And if you see the profitability of the last quarter, September 23 quarter, there is a significant improvement of around 31% increase YOY. It is more than 33,000 crore in the last quarter. So, and we are really fortunate to have the governor RBI, and he is not the governor only of our country, but he is the best governor of the international, because the governor has already been awarded the best governor by the central banking. Building resilience will not happen overnight. It requires capital, astute planning, capability-driven strategies, robust risk management, good governance, and investment in the human capital. To build resilience in the organization like bank, it is observed that in times of the uncertainty, all stakeholders, employees, investors, customers, and the suppliers make more intense demand for information. They constantly seek data and perspective that can help them build their own resilient and dynamic strategy. During the period, effective communication is quite critical. Opening up the channel of communication will strengthen the bonds linking stakeholder and expand the views of what is possible. Rather than being an excuse to the detach or check out, the uncertainty should be a motivational to engage and build sustainability advantage. Having highlighted of my thought on the building resilience, we are quite fortunate to have a tag of the fastest growth economy, with the growth rate of the 3.3% for the year projected by the IMF, which is slightly lower the RBI growth projection of the 6.5 for the financial year 24. Latest reading of the retail inflation of 4.9% is the quite comfortable, and the RBI has projected the inflation 5.4 by the March 2024. These indicators are quite positive and encouraging, and also highlight the continued resilience of the domestic economy. The banking sector continues to show the good business growth, and profit numbers and assets quality of the banking sector has improved substantially, giving them the roof to support the credit growth. The banks are expected to see a good year, financial year 2024, and our economy and the financial stability have helped the banking sector to continue its robust performance. The two-day program of the FIBAC covers almost all the segments of the banking sector like corporate finance, corporate SME, risk management, innovation in the digital banking, climate risk management, infrastructure funding, and human capital management. I hope the deliberation of these panels and thought and ideas shared by the expert would definitely help the participant to collect some guidance for building the resilience of system and the process to charter through this uncertain time. I wish you all a fruitful conference over the next 2 years. Thank you. Thank you very much.
Thank you, sir, for highlighting some of the challenges, concerns, and opportunities for the Indian banking system in the uncertain times that we face. May I now request President FICCI, Mr. Shubhrakant Panda, for his address, please.
Shri Shaktikanta Das, Honorable Governor, Reserve Bank of India, Mr. A.K. Goyal, Chairman IBA, Mr. Dinesh Khara, SBI Chairman, Mr. Amitabh Chaudhary, Chair, FICCI Banking Committee and MD Axis Bank, Mr. Sunil Mehta, Mr. Saurabh Tripathi, Mr. Sailesh Pathak, distinguished leaders from the Indian banking sector, ladies and gentlemen. I would like to welcome all of you here, and especially Shri Shaktikanta Das, RBI Governor, to the FICCI IBA Annual Banking Conference, or FIBAC. We first did this event in 2002, so it's been a little more than 2 decades, although it wasn't called FIBAC then. That's something that came up later. So your presence at this important event is deeply gratifying. And I would also like to take this opportunity to thank the IBA for their engagement with FICCI, not just with this conference, but also working on various issues throughout the year involving the banking sector. FIBAC has a track record of more than 2 decades and provides a stage for both sharing best practices as well as networking opportunities. Before I go on, let me also take this opportunity to acknowledge the presence of Dr. Anish Shah, President-elect FICCI, in the audience, and 6 past presidents. And on a lighter note, I think my quip about an award for the most active past president is having the desired effect. So to talk a little bit about the current outlook, global economic recovery remains muted on account of geopolitical developments. In addition to the long drawn-out war in Europe, we also have a raging conflict in the Middle East, although it looks like that might take a little bit of a pause now. But having said that, the uncertainties obviously remain. And along with that, the synchronous tightening of monetary policy has certainly proved challenging for policymakers who remain wary of inflation. In this context, on behalf of industry, I certainly appreciate the RBI stance, which is supportive of growth, and policy interventions which prioritize stability. Amidst all this, of course, as we all know, India remains a rare bright spot. Growth this year is expected to be around 6.5%. In fact, for the latest quarter, we have seen that number be in the high, about 7.5 or 7 or thereabouts. Fiscal and monetary policy working in tandem not just imparted resilience to the Indian economy during COVID, but also aided the post-pandemic recovery and helped keep inflation under control, unlike in advanced economies, where I think stimulus measures on steroids has led to hard-to-control inflation. Foreign exchange reserves have been stable, and after reaching an all-time high of 645 billion in October 2021, they have been fairly stable. And exchange rate volatility has been very well managed without influencing directionality. Amidst all of this, banks have bolstered their balance sheets at the start of the pandemic, while cyclical sectors have since deleveraged and are well placed for growth. So even as there is a feeling of wait and watch because of primarily geopolitical developments, but I think in India we While we are certainly not not an island, not immune to what goes on around us, but there is a fair degree of confidence about where we are and where we are headed. To talk a little bit about the state of the banking sector in India, credit growth has accelerated since early 2022, and scheduled commercial banks have witnessed momentum and profitability with the net interest margins improving by 30 basis points. Macro stress tests for credit risk suggest banks in India would be able to comply with the minimum capital requirements even under severe stress scenarios. And as such, the stage is set for India's banking sector, which today still meets about 68% of corporate India's banking needs. So the stage is set for the banking sector to support rapid economic growth. And clearly, the central bank deserves credit for a steady hand on the till. And of course, the governor's leadership has been outstanding. And I don't think there is any doubt about the fact that he richly deserves the A+ ranking in the Global Financial Central Banker Report Card for 2023. May I request all of you to give a big hand. To talk a little bit about India's growth aspirations, we are, of course, the fastest growing large economy, expected to be third in the pecking order before the end of this decade. And the journey to being a $5 trillion economy and more, because that is only just an interim landmark, if I can put it that way, not to mention action to mitigate climate change. All of this requires large amounts of capital. A detailed study by FICCI laid out some of the aspirational targets for 2030, which is to increase share of formal sector lending to MSMEs to about 80% from the current 40%, to increase the share of green assets in the lending portfolio of banks to about 40%, to achieve a 100% score on the RBI's Financial Inclusion Index, and to reduce cost of intermediation to 1% to match efficiencies of peer economies. India also needs a lineup of large banks and must aspire to have at least 5 amongst the top 50 in the world in terms of market capitalization by the time we celebrate 100 years of independence. I'm confident that RBI will continue to guide the banking sector during this journey as it evolves to meet the needs of our economy and industry. To talk a little bit about financing needs of industry, energy transition, decarbonization, and other actions to mitigate climate change will require large amounts of funding. And this is especially important for SMEs who are often not financially savvy. In this context, I just wanted to share that we recently released the FICCI report on SMEs in India, which talked about awareness of and preparedness for digitalization and sustainability. But talking about sustainability in the context of the point I just made, we were pleasantly surprised to see that 72% of respondents were aware of sustainability practices, had been helped by their buyers who wanted compliant supply chains, and were keen to implement sustainability measures, but were constrained by lack of funding. So this is clearly something that we need to work on. Banks and financial institutions need to also work together to build an ecosystem around underserved segments like logistics, healthcare, etc. And a point which FICCI has suggested in the past, that given India's stable foreign exchange reserves, perhaps allocating a small portion, say 10%, can be considered to enable lending to long gestation projects and export-driven sectors. In conclusion, deliberations over the next few days on various issues critical to further unlocking India's growth potential will take place, and I'm sure, as I mentioned, that this is a wonderful platform to discuss, debate, and figure out jointly what is the best way forward. India is rightly being considered the world's growth engine, which incidentally is the theme of FICCI's upcoming 96th annual convention. And I'm sure that all stakeholders will work together to achieving alignment so that the national imperative of sustainable, resilient, and inclusive growth is achieved. Thank you once again to the Honorable Governor for taking time out from a busy schedule to be with us, and to the Indian Banks Association for partnering with FICCI, in particular Mr. A.K. Goyal and Mr. Sunil Mehta for their guidance and support. Thank you once again.
Thank you, President, and I'm sure we would all agree that what Mr. President mentioned about the state of Indian banking sector, and it does inspire a lot of confidence about a future growth trajectory and the role which the Indian banking sector can actually play in meeting the growth aspirations of the country. We now move on to release this year's knowledge report on the theme Winning in Uncertain Times. May I request RBI Governor to unveil? We'll have kindly present the report, please. So the knowledge report actually talks about 5 imperatives for the banking sector: generative AI adoption, digital public infrastructure, future of distribution, climate strategy, and risk management maturity that would ensure sustained growth amidst the current volatile environment. The report puts forth some of the very insightful data. Thank you, sir, for launching the report, and this will also be available on the website very shortly. May I now request Saurabh from BCG to throw some more light on the knowledge paper.
Honorable Governor, dignitaries on the dais and dignitaries in the audience, very good morning. It's a great honor for BCG to be a partner for the banking industry for this phenomenal platform for last so many years. I'm going to just summarize some of the key findings that we are observing from our research across the globe, and that is relevant for the Indian banking industry. Honorable Governor, I can understand the huge praise that you and the institution of Reserve Bank gets from across the world. As we looked at the valuation of Indian banking industry stands out completely compared to everything else in the world. 75% of the equity invested in the banking industry in the world is not returning cost of equity, 75%. And actually 65% of the equity invested in the banking industry has not returned cost of capital for last 10 years. And in light of that, India stands out as one of the few markets where the banking industry is actually shining, with price to book ratio really touching 2.0. And this is not just reflective of the phenomenal opportunity in India, but it is also reflective of the very prudent and practical approach that this regulator has taken, not just to control the risks, but also to improve the innovation and the level of development of the Indian banking industry. So thank you very much, Governor, and thank you to the Reserve Bank for orchestrating the economy so well. Now, the issue is, when we look at, so this is the chart for which the whole world appreciates why Indian banking has reached where it has reached. You can clearly see it stands out compared to every other jurisdiction in the world in terms of how investors value Indian banks. It is very important to note that as we see many jurisdictions across the world, when banking industry is sustainably profitable, then it really supports the financialization of the economy. Deeper penetration of banking happens in those economies where the banking industry is sustainably profitable, which is the yellow line here. And then the other lines are for less profitable industries. And you can see over time, the penetration of banking in the economy, in the GDP, does not go forward as much as one would like to do. So it's very important that we steer the banking sector towards sustainable profitability. And it is in this light that this de-averaging of Indian banking industry is very important. This is price to book valuation of Indian banks. There are about 45% of the banks who actually are valued below their book value. And that accounts for about 40% of total advances in the Indian economy. Obviously, there are a few banks which are rated really, really well, and which is very good. But if the banking industry in India has to serve the demands of the next 2 decades, when we expect phenomenal growth in our economy, and the whole world expects that, the banking industry, the parts of it which are not yet fully profitable, viable, sustainable, and with right capabilities, need to transform themselves to be able to rise to the expectation of supporting the economy. And so it is very clear that certain conventional and certain unconventional measures are needed to make it happen. Firstly is consolidation. We do feel that the weaker parts of the banking industry, many of them are from public sector, old private sector banks, the RRBs, they need to find a way that we consolidate the smaller players which are not at scale to be able to invest in technology in the same way that is required to make them viable. The second is that many of these segments of our banking industry need continued push for reforms so that they can actually develop capabilities which are needed for tomorrow. And there is a huge scale that is required to be a viable bank, given the investment required in technology, in artificial intelligence, in agility, in resilience, and so on and so forth. So we need to continue to push very hard for reforms for the segments of Indian banking which are, which are not at scale or do not have the right capabilities. The third thing is we need to introduce more capital into the Indian banking industry. And of course, RBI is always looking for fit and proper candidates for giving banking licenses. But I think it is also time to see whether we can heavily incentivize wholly owned subsidiaries of banks from well-regulated jurisdictions. Because that is one way to get high-quality capital, and it is in the interest of the economy to heavily incentivize that type of financial institutions to come and, of course, be a wholly owned subsidiary. And then the last one is a slightly unconventional one, which is what we are noticing across the world, which is the banks. Large banks have a lot of wherewithal, but the mid-sized, the small banks don't. But we need everybody. We need a lot of competition, and we do not want huge amount of consolidation too. And hence, shared utilities and financial infratech is a very integral part of the vision for the future viable banking industry. What do I mean by that? There are utilities which are needed to support banks in providing them capabilities and scale. And in coming days, the climate data is going to become a very huge problem. Most of the banks which are trying to do better disclosures, which are trying to support the industry in climate transition, they need huge amount of data. And it is not possible for each bank individually to do that. We have seen how successful NPCI as a shared service of the banking industry has been in terms of supporting the evolution of payments in the country. And similarly, we need utilities for climate data, utilities for cybersecurity, which is growing by the day in terms of its importance, and transaction monitoring for cybercrime. These utilities can really provide banks with the ability and scale to really deal with the future. And the last point is fintech. We all know that after US, India is the only market which is being looked at as a very attractive destination for huge investments in fintech. Over the last 20 years, about 30% of the investment has gone in a very special type of fintech which serves the banks, does not compete with the banks. We call them financial infratech. These fintechs make banks better by providing them capabilities and, of course, providing them scale across different players. They can help banks with sourcing and onboarding, underwriting, core operations, and so on and so forth. And it is also possible for us to imagine that this segment of fintech coming from India could actually serve the entire banking industry of the globe through software as a service, as a very big potential development. Why it needs your attention, Honorable Governor, is that we need to create an environment and framework so that financial infratech of this type actually finds it easy to integrate with banks and gets easy onboarding. Otherwise, this type of fintech typically takes a lot of time through bank-by-bank onboarding process, which is very, very cumbersome. It impedes the progress of a very important segment in the financial ecosystem. So the sandbox, which is already there, but also protocols, self-audit mechanisms, and also accreditation by either the regulator itself or through other third parties, SROs, etc. So this type of framework, if a study could be conducted to make sure that we can create a framework like that, that could actually facilitate a much more stronger banking industry over the next 5 years as we see the trends coming towards us. Thank you very much.
Thank you, Saurabh, for a very insightful presentation as always. The Indian banking sector indeed is in a strong position, but to maintain that and safeguard it from the global turbulence, there is a need for a structured plan, and that is what you just presented. We now, of course, move to the address of the day, the inaugural address by Sri Shaktikant Das, Honorable Governor, Reserve Bank of India. I have the pleasure to invite him here, and of course, he doesn't need any introduction, but we all know he's a career civil servant with over 42 years of distinguished service. He possesses a unique combination of experience in both policy formulation and implementation at the highest levels in the state and the central government, a pioneer and an exemplar leader, and we all know he's therefore been awarded as the best governor at the global level. And sir, the recent set of challenges were unprecedented, and way you handled it, we all know. And I have the pleasure of now inviting you for the inaugural address and request everybody to please welcome him with a round of applause.
Good morning. I'm extremely delighted to be here. In particular, particularly for the reason that here we have the presence of the participants and the leaders from the real sector of the economy as well as the financial sector of the economy. And this is a unique event in that sense, the FIBAC, FICCI, and IBA coming together to organize this event. And therefore, I have a sort of a prepared speech, which is for about 20-25 minutes or so. And the copy of that will be uploaded in the RBI website immediately after my speech is over. But in between, I may deviate and make a few points here and there, depending on the level of, the response of the audience which I see. So may I now start by saying that Sri Subrakant Panda, President FICCI, Sri A.K. Goel, Chairman IBA, other distinguished persons and dignitaries on the dais, respected members of FICCI, IBA, and leaders and other participants from both the financial sector and the real sector, ladies and gentlemen, members from the media who are present here. Once again, a very warm good morning to all of you. I'm indeed thankful to FICCI and IBA for once again inviting me to participate in this FIBAC conference. This is the third event I am participating. The first one was in 2019, then again last year, and now. As momentous changes are taking place in the financial and business landscape, events like this provide us an opportunity to industry leaders, bankers, and policymakers to deliberate on issues of our times and crystallize our thoughts for future guidance. Today, the world is grappling with an unrelenting and unending string of challenges since 2020. Geopolitical conflicts, geoeconomic fragmentations, volatile commodity prices, uncertainty in trajectory of monetary policies and their macro-financial implications, increasing frequency and ferocity of climate shocks, all these prevailing together present a very complicated and, should I say, deadly mix of challenges. And these challenges are not just for policymakers, but for every player who is there in the business world, every player who is there in the industry world, every player who is there in the financial sector. Historical regularities are looking improbable and policymakers are being put to test. In this backdrop, the theme of today's conference, Winning in Uncertain Times, aptly captures the long-standing quest of humanity to make progress against all odds and challenges. I am an optimistic and I remain confident that we can work together and navigate through this stormy weather. In tune with the theme of the conference, I would like to touch upon the Reserve Bank's policies and actions in the last 1.5 years in particular to maintain macroeconomic stability. I would then proceed to talk about India's growth drivers and emerging opportunities that can be harnessed to enhance India's potential growth. In the end, I propose to highlight certain key issues which merit attention of banks, NBFCs, financial sector entities, and even businesses. The monetary policy actions of the Reserve Bank over the last 1.5 years, consisting of prioritization of inflation ahead of growth, and as you would recall, we did it in May 2022, or rather April 2022, we did it, that is prioritization of inflation ahead of growth, narrowing the liquidity adjustment facility corridor, increasing the policy repo rate by 250 basis points cumulatively starting May 2022 till now, draining out excess liquidity, together with certain supply side measures undertaken by the government, have facilitated significant softening of headline inflation to 4.9% in October 2023. The moderation in core inflation in particular is noteworthy. There is also recent evidence of household inflation expectations becoming more anchored. Headline inflation, however, remains vulnerable to recurring and overlapping food price shocks coming from global factors and local adverse weather events. The frequency and intensity of such shocks have increased in the recent period. Monetary policy in such a scenario needs to remain watchful and actively disinflationary while supporting growth. I must add that our actions over the past 1.5 years did not engender any financial stability risks as witnessed in some advanced economies in the early part of 2023. This may be attributed to the regulatory requirements prescribed by the Reserve Bank, which banks are expected to follow to manage their interest rate risk. These requirements act as safeguards for future stress that may arise when the upturn of the interest rate cycle takes place. So, if you recall what happened in particular, let us say in the United States, I mean, from whatever I see from this distance, and this is something which is known to perhaps most of you, but just to explain what I was trying to say is that, a very interest rate increase of very high order in quick succession led to a situation where the banks and the other lending institutions came under stress. I don't blame the Fed for it. The US Fed was probably doing its job because they had to bring down inflation. High inflation is a challenge, is I think a complete no in the US economy. So Fed was completely focused on inflation. But the financial institutions and the banks, perhaps they had not adequately factored for the change in the cycle, for the cycle to turn down. That is, perhaps there was a belief that this low for long interest rates remaining low for long will continue to remain long and perhaps will continue to remain so till eternity. Now, that's a fundamentally wrong assumption. So, therefore, whenever interest rates are low or any situation, I think one has to always prepare one has to always keep his balance sheet so resilient that it's able to withstand the shocks which may originate when the cycle turns. So I think perhaps that is something which happened, and lot of literature is already written on this. There will be more research as to what happened in the United States banking sector. But so far as the Reserve Bank is concerned, we are fully mindful of such possibilities because we have seen them in the past. And having seen them in the past, the Reserve Bank, as the bankers who are present here, they would very well know. We have, for example, we have prescribed capital and liquidity requirements, and we have made them uniformly applicable to all scheduled commercial banks, irrespective of their asset size and exposure. I'm talking about scheduled commercial banks. We have also investment fluctuation reserves requirement, which the banks and which the banks are expected to create, and they have created. We have also introduced valuation guidelines valuation guidelines on available for sale category of investments, and which are pretty stringent. And our approach has been fairly conservative in this regard. So therefore, so far as India is concerned, we did not see the kind of financial stress or the banking stress because our regulatory requirements ensured that the banks themselves had taken the required steps, and they were ready for a change in cycle and for a regime where interest rates are tightened and interest rates are increased by the central bank. Also, what helped was that our calibrated approach in increasing the interest rates. Recently, in a speech which I delivered in Delhi, those of you who are interested may like to have a look at it at the Kautilya Economic Conclave. There, the focus, the theme of my address was the interdependence between price stability and financial stability. Now, price stability is very important for financial stability. Financial stability is also very important to ensure price stability, and there is an interplay between the two. And in that speech, I have tried to explain and tried to demonstrate by using certain, recent examples how sometimes excessive focus on one at the cost of the other can generate potential stress. And I have argued that what is therefore required in all situations is to take a balanced approach. And you need, both price and financial stability, they need each other. But that balanced approach is necessary so far as policymakers are concerned, because financial stability ultimately is the backbone for any country's growth, and price stability also is something which impacts not only household consumption, not only the standard of living of the people, but it also impacts financial stability. So I'm not going further detail into that, but let me now move on. Now, on exchange rate front, I was talking about our recent policies and the recent situation that prevails. On the exchange rate front, the Indian rupee has exhibited low volatility and orderly movements relative to peers despite elevated US Treasury yields and strong US dollar. It's different that in the recent last 3-4 days, the US, the Dixie has sort of slightly softened, and the Treasury yields in US also have softened, but that's only in the last 3, 4, or 5 days. Now, movements in the Indian rupee are, as we see them, movements in the Indian rupee are consistent with the strength of the underlying macro fundamentals of our economy and the reassuring availability of buffers, that is the foreign exchange reserves, which we have built up. So I was just talking about, what I have just said. Let me clarify for, it's open to interpretation, but let me also make it very clear to my media friends and other analysts who are present here, and all of you who follow the, the monetary policy very closely. I'm not giving any forward guidance or indication so far as the next monetary policy is concerned, which is coming up on the, which is coming up on the 8th of, the announcement will be on the 8th of December. I'm not giving any forward guidance, but I would just like to slightly deviate, slightly, step aside and just explain to you our approach. I did say that inflation has moderated, but I did say that the overlapping and continuing shocks are, especially from food inflation, is causing tremendous volatility and can act and provide upward pressure on the headline inflation, because ultimately it is the headline inflation which is our target. Having said that, I also mentioned that core inflation has softened, and I think that is demonstrative. Somewhere I think that gives us the conviction that monetary policy seems to be working. Now, having said that, we are completely focused on the 4% target. I have said it again and again that we maintain an Arjuna's eye on the inflation target. We keep an Arjuna's eye on inflation, on inflation, and we are completely focused on inflation. But at the same time, let me just, say sort of make it a little nuanced, and let me sort of try to explain it in a different way. If you recall, the child Arjuna was completely, when Dronacharya was, those of you who have read Mahabharata, and I presume everyone is aware of what the Mahabharata is all about. Now, when child Arjuna was asked by Guru Dronacharya to focus, to take aim on that parrot which was there on the tree. Now, the other princes, the other Kaurava and Pandava princes, somebody said, I'm seeing the tree, somebody said, I'm seeing the bird, somebody said, I'm seeing the sky. It was only Arjuna who said that I only see the eye of the parrot. So the child Arjuna was completely focused on the target. Like that, the central bank is completely focused on the target. But think of another situation in Mahabharata when the youth Arjuna was there was participating in the Swayamvara. He had to take aim on the fish which was rotating on the top, revolving on the top, and he had to take aim through the water. So he had to also completely focus on the eye of the fish because he had to hit the eye of the fish which was hanging, upside down. But at the same time, he had to see through the eye of the water. And there were ripples in the water. So he had to be mindful of what are the ripples in the water. What is the wind factor? How much of wind is there? The noise level in the room and the other distractions all around. And he had to still take the aim. He had to still hit the target. So while being focused on the target and committed to hit the target, he was also factoring in the other conditions which will enable him to hit the target. So therefore, like that, the Reserve Bank is completely focused on achieving the target, but we do consider several other factors which play their role in determination of our policy decisions. That is how we do it. Now, sometimes, sometimes a few persons have asked me that, when they have raised this question with me privately, that look, when you talk of this, you give us example of Arjuna's eye and explain things the way I did it now. Or when in one of my monetary policy statements, that was immediately last year, I think, after the death of the legendary Lata Mangeshkar, somewhere in my monetary policy statement, I mentioned that Aaj fir jeene ki tamanna hai. Or sometimes in my interviews, I refer to the need. Recently, for example, somebody asked me your advice to the financial sector and in particular to the banks. I said, play long term, play like Rahul Dravid. Now, I have been asked that, why do you do this? Doesn't it dilute the seriousness of the occasion? Now, I want to sort of use this forum and through you, convey to the wider audience. Now, what is the objective of the central bank? Central bank communication, and in particular, there is something called, I just read about household inflation expectations. Now, how is the household inflation expectations, how is it formed? It is formed by when the household goes in the morning to buy vegetables, when they go and buy the monthly groceries, it is impacted by the electricity bill and the milk bill, it is impacted by the house rent they have to pay, it is impacted by their real experience. Now, if it is impacted by their real experience, whether prices are going up or going down, now how does the central bank influence household expectations? The central bank can influence household expectations, inflation expectations, one, by taking actual action, that is increasing interest rates or tightening liquidity, measures like that, which are real actions, and backing it up with appropriate communication. Now, communication has to be in a manner that it reaches the wider audience, including the households. Ordinary households living in tier 2, tier 3 cities, and the level of interest these days, we should not assume that they are not aware of what is being said by people who are in authorities. When I take a flight, you will be surprised to know that, people who you would expect they're not aware of what is happening in the financial sector. They come up to me and ask, I was going through the security check. So that guy, the CISF Jawan was doing the security check, and after he completed, he said, sir, can I ask you a question? And this has not happened once. This has happened several times. I said, हाँ पूछो क्या है? What is that? So he told me कि sir ये जो interest rate आपने ऐसे किया, उसका what will be the impact on this? Now that is the kind of awareness that is so. That means he is reading the papers, he is following what we are saying, he is following what actions are being taken, and then I stood there for I sort of explained to him very briefly and told him कि look. I don't want to take more time because there's a queue behind me. They are getting impatient. So therefore, in brief, this is the position. And he was very happy. So therefore, if the central bank, which is to influence household inflation expectations, its communication has to be in a manner that it reaches the wider audience. Now, just imagine if I say that, we are completely focused on inflation targeting, but we to keep in mind multifarious factors, including global, domestic, local. Now, it's all right. I mean, the audience here will understand, but then what sense it makes to the wider audience? So when I explain it by using the simile from, from Mahabharata, the drop parallel to Mahabharata and explain it, Arjuna you in his youth and Arjuna as a child, I think at least I am convinced, I mean, somebody may not agree with my communication method, but I am convinced that I think we are reaching out to a wider audience. So that is why it is necessary that central bank communication in these times do play an important role. And over the last, ever since the COVID in particular, it was before that also it was there, but particularly after COVID, when the country and the whole world was facing multiple shocks, I and my colleagues in the Reserve Bank have been very, very careful in, in our communication to the wider audience. Now, as many business leaders are present here, let me now dwell upon India's growth drivers and the opportunities that lie ahead. The Indian economy rebounded strongly from the COVID-induced contraction of 5.8% in 2021 to a growth of 9.1% in 21-22 and 7.2% in the last financial year 22-23. India's real GDP is expected to grow by 6.5%, both in the current year 23-24 as well as the next financial year 24-25. And that would make India one of the fastest growing large economies in the world. In fact, and quite interestingly, India is already the third largest economy in the world in terms of purchasing power parity. Despite global slowdown, the Indian economy has remained resilient and continued to grow due to its higher reliance on domestic demand, which enabled the economy to weather multiple global headwinds. Although India has made rapid strides in external openness through trade and financial channels and gained in competitiveness, India's dependence on domestic demand provides a cushion against external shocks. At the same time, various structural reforms implemented in the areas of banking, taxation, inflation management, and manufacturing sector and similar other areas over the last few years have laid the foundation for sustainable high growth. We have moved from an era of twin deficit and twin balance sheet stress to the current period of twin balance sheet advantage. While balance sheets of banks witnessed significant improvement on the back of improved asset quality and profitability, corporates also display stronger financials, having deleveraged their balance sheets. The improved health of banks and corporates is also reflected in their recent second quarter results for 23-24. The corporate performance parameters based on 1,501 listed non-government financial companies. I repeat, the corporate performance parameters based on a survey of 1,501 listed non-government, non-financial companies suggest strong growth in profitability and staff costs in the second quarter of this year. The Reserve Bank's latest industrial outlook survey also indicates that business outlook has further improved, with manufacturing firms being optimistic about demand condition in the third quarter of the current year. Capacity utilization in the manufacturing sector on a seasonally adjusted basis continues to trend up, which augurs well for investment activity. Now, I saw also the FICCI survey, which was reported recently. I think it came out in the media, and I'm aware that your survey also perhaps gives out a similar result. The continued thrust on capex by the government is also favorable for investment activity. It is now for corporates and other businesses to evaluate the current situation and future potential of India and move forward. On the supply side, The agricultural sector has kept good momentum over the last few years, and its performance is expected to remain stable during 23-24, despite uneven southwest monsoon and lower kharif production. Production of fruit, food grains, as well as horticulture have reached record levels year after year. The diversification of exports, both in terms of products and destinations, is enhancing the economy's capacity to withstand the shocks. The agricultural sector continues to provide employment to a large part of our workforce. Now, there are, however, several challenges relating to productivity gaps, water usage and irrigation facilities, shifting consumer preferences, and sudden weather events, all of which do impact the agricultural sector. Now, all these require heavy investments in infrastructure and innovation to modernize the agricultural sector and realize its true potential for achieving higher productivity, more efficient access to markets, maximizing farmers' income, and increasing its contribution to the GDP. That is, increasing the contribution of the agriculture sector to GDP. As a nation, we must find a way of carrying out certain reforms, especially in the area of agricultural marketing and the connected value chains. These reforms are critical not only for sustained high growth, but also for durable price stability and to mitigate the frequency and intensity of food price shocks. It is important that private sector comes forward in a big way and becomes a crucial partner in this journey. There are opportunities for the private sector to invest in strategic areas of agriculture and allied activities such as supply chains, food processing involving variety of fruits, vegetables and food grains, scaling up dairy, poultry and fishing, and creating market infrastructure. Private sector can also accelerate farm to firm, that is agri-industry linkage, and improve the efficiency of the entire value chain right up to the end consumer. As regards the manufacturing sector, even as the share of the economy has been around, even as its share, that is the share of the manufacturing sector in the economy has been around 17 to 18% over the years, it has potential to accelerate its contribution to growth and employment. India's demographic advantage with its young population, with its young labor force, also presents a unique opportunity to become a key player in the global manufacturing. It is important for us to be part of the global supply chains which are undergoing realignments in the fragmented global economy. Initiatives like the production linked incentive, that is the PLI scheme of the government, create conducive conditions to enhance the share of manufacturing in our GDP. Sectors such as smartphones, large scale electronics, pharma, food processing, auto and auto components have recorded good performance under the PLI scheme. There is also huge potential in emerging areas such as aerospace and defense, low carbon technologies, electric vehicles and semiconductors, and similar other areas. Our efforts towards building robust public digital infrastructure, which is fostering digitization and ease of doing transactions across the spectrum, will continue to provide strong fillip to technology adoption and productivity. At present, now I would like to turn to the services sector. At present, the services sector contributes the largest share in India's GDP and remains an anchor of India's overall growth. The Indian services sector is fast adopting new technologies such as artificial intelligence, Internet of Things, cloud computing, and data analytics to improve service delivery, reach, and competitiveness. The newly emerging startups are also largely concentrated in the services sector. There is a steady shift from low skill, consumer oriented services towards more technology enabled business services. Indeed, there is a case for Indian businesses to recognize this undercurrent and work towards upscaling their activities to meet the external demand in this sector. In fact, India commands a strong external position thanks to the strength of our services exports, which have largely remained resilient. They have supported India's current account deficit, even as merchandise exports have been under pressure in the face of weakening global demand. The current account deficit to GDP ratio of India has remained under 2% for almost 10 years now. India's services exports are diversifying from information technology related services to other professional services such as business development, research and development, professional management, accountancy, and legal services. Overall, India's growth journey, with active participation of the manufacturing and services sectors and dependence on domestic demand, could be self-fulfilling in the years to come. Let me now turn to the financial sector. As the Indian economy strives to grow in an evolving and uncertain global environment, it is imperative that our financial sector remains strong. The Indian banking system continues to be resilient, backed by improved capital ratios, asset quality, and robust earnings growth. The financial indicators of non-banking financial companies, that is NBFCs, are also in line with that of the banking system as per the latest data available. While banks and NBFCs are showing good performance now, sustaining it requires concerted efforts. In good times like these, banks and NBFCs need to reflect and introspect as to where potential risks could possibly originate. Now is the time for them to further strengthen their risk management practices, build additional buffers to face the situation if the business cycle turns adverse in the future due to some reason. Now, we are quite optimistic about our business cycle, we are optimistic about our growth, but I think good governance, a good management practice would be to remain prepared if due to some unforeseen reason the cycle turns, then whether to what extent the balance sheet of banks, NBFCs, and other financial institutions are resilient. So basically, as financial institutions, they have to remain resilient at all times and resilient in all situations. On our part, the Reserve Bank of India has significantly strengthened its regulation and supervision of the banks, NBFCs, and other regulated entities in the recent years. We have also very recently announced a few macroprudential measures in the overall interest of sustainability. These measures are preemptive in nature. They are calibrated and targeted. It may be relevant to note that major growth drivers like loans for housing, vehicles, and the MSME sector have been excluded from these measures. Now, we have excluded them because at the moment, we don't see a possibility of buildup of stress. I'm not ruling out that possibility, but it was also a conscious decision to leave out certain sectors which are contributing to growth, because growth also needs to be sustained. We continue to focus on strengthening governance and assurance functions, ensuring effective risk management and robust lending practices. We are monitoring the supervised entities through various on-site and off-site tools, stress testing, vulnerability assessments, thematic studies, and data dump analysis, and similar other instruments. Now, this is being done as part of our proactive and forward-looking supervisory approach. Banks and NBFCs and other financial entities must continue to do stress testing of their books. They are already doing it. What I'm saying is that they must continue to do it. In fact, there is a strong case for companies in the real sector also to stress test their businesses and balance sheets. Many of them may already be doing so, but it would be desirable that many more also do this. At the current juncture, there may not be any immediate cause for worry, but to remain on top of things, banks and NBFCs would be well advised to take certain precautionary measures. In this context, I would like to highlight 4 points. First, while credit growth is accelerating in the current period, banks and NBFCs may take due care to ensure that credit growth at the overall sectoral and subsectoral levels remain sustainable, and all forms of exuberance must be avoided. Expansion of the credit portfolio itself and pricing of the same should be in sync with the risks envisaged. Banks and NBFCs also need to further strengthen their asset liability management. They may give greater attention to their liabilities side. In certain cases, we have observed increased reliance on high cost short term bulk deposits, while the tenure of the loans, both in retail and corporate loans, is getting elongated. Now, many banks are already doing it. I'm not saying that it's not being done, but as the central banker, it is our responsibility to point out and to ensure that every bank does it, and the banks which are doing it even do it with greater, with greater focus. Second, I said 4 points I wanted to mention. The first I have already said. Second, given the increasing importance of non-bank financial companies, that is NBFCs in the financial system, the increasing interconnectedness between banks and non-banks merits close attention. NBFCs are large net borrowers of funds from the financial system, with their exposure from banks being the highest. Banks are also one of the key subscribers to the debentures and commercial papers issued by the NBFCs. NBFCs also maintain borrowing relationships with multiple banks simultaneously. Needless to state that such concentrated linkages may create contagion risk. Though the banks are well capitalized, they must constantly evaluate their exposure to NBFCs and the exposure of individual NBFCs to multiple banks. The NBFCs, on their part, should focus on broad basing their funding sources and reducing over dependence on bank funding. Third, microfinance has emerged as an important financial conduit to foster financial inclusion. As microfinance institutions, that is MFIs, are catering to the marginalized clientele, they have to bear in mind the affordability and the repayment capacity of the borrowers. Though the interest rates are deregulated, certain NBFC MFIs appear to be enjoying relatively higher net interest margins. It is indeed for macrofinancial lenders themselves to ensure that the flexibility provided to them in setting interest rates is used judiciously. They are expected to ensure that the interest rates are transparent and not usurious. Fourth, the increased collaboration of banks and NBFCs with fintechs is facilitating introduction of innovative products and services and new business models. Digital technologies are offering a powerful medium to access banking and financial services. This has brought down the operational costs and helped in enhancing the reach of financial services, of the reach of the financial service providers. An important aspect that merits attention in this context is with regard to model-based lending through analytics. Banks and NBFCs need to be careful in relying solely on preset algorithms as assumptions based on which the models are operated. These models should be robust and tested and retested periodically. They may require to be calibrated and recalibrated from time to time based on the changing contours of the financial ecosystem and fresh information. It is necessary to be watchful of any undue risk buildup in the system due to information gaps in these models, which may cause dilution of underwriting standards. Now, let me try and conclude. We are living in highly uncertain times in an interconnected world. New risks are emerging from time to time. New sources of risk are also coming up. In such a scenario, building up further on resilience would be the best insurance against shocks and uncertainties. This holds good for all businesses and financial entities. As I see many banking and corporate leaders in the audience, let me also stress that new opportunities are knocking at our doors. It is for us to capitalize them. There are there has to be greater focus on investment in capacity building, skilling of human resources, and adoption of newer technology by all players, whether from the real sector or from the financial sector. The international confidence on India's prospects is at a new high. It is an opportune time to make this India's moment and work towards strong, sustainable, and inclusive growth. Thank you very much.
Thank you, sir. I think a lot of speakers did talk about earlier about the Indian economy potential and the resilient banking sector. But of course, as you mentioned, it's all because of the balanced and the balanced regulatory environment provided by the Reserve Bank of India. And you also talked about the simple to understand and timely communication, which is indeed a very important matter. Thank you once again, sir, and request everybody to please again welcome him with a round of applause. May I now request Mr. Sunil Mehta, Chief Executive IBA, our partners in this event, for the concluding remarks, please.
ऐसे ही नहीं किसी को बेस्ट सेंट्रल बैंकर चुना जाता है। कुछ तो अलग होता है जो जमाने को रास्ता दिखाता है। We all have heard our Honorable Governor Shaktikant Das ji, while maintaining his optimism about the Indian economy, about the Indian banking sector, he has put in a word of caution for all of us. Befitting the today's theme, winning in uncertain time. The mantra, plan for the best, but prepare for the worst. Thank you, sir, for giving us a guiding light to the entire economy and the industry and banking industry in particular. He has opened up his mind and explained to us how do the central banker think about various decisions and how a worry of a small common man while going for buying a grocery or buying a milk product in the morning are translated into the inflation and the expectations and are factored into the monetary policies of the regulator. Sometimes, yes, we as a banker crib on some of the issues. We say, no, this will increase our cost, this will increase our capital allocation. Sometimes we are not able to understand the prudence for taking those policy decisions. But I think by quoting the examples of Mahabharata, that focusing on a achievement, the goal, and goal is price stability, financial stability, the policies need to be designed and keeping a word of caution, especially when there is a good trajectory of the growth. I think it was a very good pillar for all of us to understand the decisions taken by the regulator and our own management, risk management systems to prepare for worst time while enjoying the best time. Chairman IBA, Goel Sahib in his welcome address has already narrated the stability story of the Indian banking sector, how we have grown not only in our capital adequacies, but in our profitabilities and the business. He has also elaborated on uncertainties, because uncertainty is a part of the life. He quoted the example of weather. He quoted the environment. So uncertainty is a way of life. And managing an uncertainty is way forward. And I think the way uncertainties of our Indian economy and the financial sectors have been managed, especially during the COVID time, and under the present geopolitical situation, are not only acknowledged within country. I can share with you, as a member of the board of the International Banking Federation, 76 countries were participating, and when we were deliberating, most of the countries unanimously agreed that the policy measures taken by Indian government during pandemic and the measures taken by the Indian regulator were unparalleled. No country has come out with an emergency line of credit. No country has come out with a TLTRO windows. Very few countries have come out with the support system. So, lot of support that was provided by the government as well as by the regulator during the uncertain time has given us a tool and a leverage to sail through smoothly during this uncertain time. Proactive steps by regulator has really helped the economy in general, industry and MSME in particular, and banking sector, definitely. Mr. Shubhrakant Panda, in his deliberations about the industry, has narrated about the journey that industry is taking, the aspirations they have with the financial sector, and the performance of the Indian industry during the preceding time. Governor has also touched upon the issues of unveiling opportunities in front of us, because the India is now being recognized as a leader not only in the payment space. We have the largest number of digital transactions. The success of the UPI, we are pioneer there. The entire world recognizes it, that the payment infrastructure that has been created in our country is unparalleled, is a matter of envy for many of the other countries. And the type of opportunities that are unbundling because of the infrastructure growth that is planned, the infrastructure vehicles that has been created, like NEPFID and other institutions to grow, will definitely help our economy to maintain the level of growth which is expected. Mr. Saurav Tripathi, while giving the analysis about the world economy and relating it and narrating the gist of the studies undertaken by BCG, has elaborated on the various issues. I'm thankful to all of them for giving their perspective, which will really broaden our way of thinking, and we're understanding each other's perspective. How do the world economy is progressing? How the challenges in the banking sector in USA has impacted them because the banks have collapsed. So how it has impacted, and Governor has touched upon those issues where we missed out. So all these things have really a food for thought, as usual, expected from our Governor, and we could get that opportunity to listen it today. I'm hopeful today's deliberation with the eminent panel of speakers available today for various sessions will definitely be an enriching experience for all of us. On behalf of IBA and on my personal behalf, as well as all my member banks, I'll definitely like to thank Honorable Governor for sparing his valuable time and addressing us in a very candid way, in a very simple and elaborate way, using the very understandable logics from Mahabharata and Lata Mangeshkar, and the learnings that, yes, how do the things can be well understood. Thank you, sir. And I hope we will be able to get the best out of today's conference. With this, I thank all the speakers for addressing us today.
Thank you, sir. May I now invite Mr. Shailesh Pathak, Secretary General FICCI, forward.
Thank you, dignitaries in the dais, ladies and gentlemen, dignitaries in the audience. I'll take 120 seconds, past, present, and future. The two logos behind us are the most powerful logos in banking and industry. One was founded in 1946, the Indian Banks Association. The other was founded in 1927. And I don't know how many of you know about Gandhiji's connection with FICCI. Mahatma Gandhi was the reason why FICCI was set up. And we are the only business association where Mahatma Gandhi was the chief guest at our 4th annual general meeting in 1931. And we are getting to the 96th annual general meeting on the 8th and 9th of December. All of you are most welcome to register and join at Vigyan Bhavan, Delhi. So that's the past. The present is that today's topic is winning in uncertain times. In 2019, where Governor Mr. Shaktikant Das was the chief guest, was preparing for a new paradigm in banking. And remember, August 2019, none of us knew that COVID was coming. We did not have FIBAC in 2020. But in 2021, when we had FIBAC in December 2021, the topic was resilience and rebound, journey to India's 5 trillion economy. And there's a Gujarati saying, sir, in Mumbai, that Bhav Bhagwan Che, the market knows best. So on 12th of December 2018, the market went up Nifty 188 points, Sensex 629 points. That was the day that Mr. Shaktikant Das joined as Governor RBI. And now let me come to today's BCG report. This is a snapshot where every single indicator that Saurabh has tracked has suddenly improved since 2018. Thank you, sir. Governor RBI, you have made that happen. Thank you. This report will be available for download on the FICCI website and the FIBAC website within the next 15 minutes. Now for the future. The RBI governor talked about three things, the steps that have been taken in the last 18 months, the growth drivers and opportunities for both the real sector and the financial sector, which is the partnership that we have with IBA and FICCI, and the 4 issues that we need to be mindful of. And the one phrase that I will carry everywhere is historical regularity, looking improbable. The past is no guarantee of the future. So I don't know, 4 years down the line, when we have the FIBAC in 2027, when FICCI will celebrate its 100 years, I don't know the risks that will come up. But the banking system, represented by IBA, and the industry, the real sector, represented by FICCI, will be resilient and will be ready for the future under the dynamic guidance of leaders like Governor RBI, Shaktikant Das ji. Thank you all the dignitaries in the dais. Thank you all for attending. Thank you.
In uncertain times. After our inaugural session, we now move to our first session of the day, CEO's panel discussion on the topic, Winning in Uncertain Time. For this session, I welcome the most eminent panel of speakers and request them to please come to the dais. Shri A.K. Goel, Chairman IBA and MD CEO Punjab National Bank. Shri Dinesh Kumar Khara, Chairman State Bank of India. Shri Hitendra Dave, CEO HSBC Bank. Shri V. Vedyanathan, MD and CEO IDFC First Bank. And our moderator for the session, Shri Ruchin Goel, Managing Director and Senior Partner BCG. Dear participants, may I request you to please take your seats. I request Shri Ruchin Goel, Managing Director and Senior Partner BCG, to initiate the panel discussion. Over to you, sir.
Thank you. Respected dignitaries on the stage, ladies and gentlemen, good morning, everyone. It's my privilege and honor to be the moderator for the first session of FIBAC 2023. The theme, as you all know, is winning in uncertain times. And, we have a very eminent panel of speakers here. Just to set the tone of the discussion, I'll take maybe about 10 minutes just to put some food for thought, and then, we'll proceed with our discussion. We all live in a world that is becoming increasingly complex and uncertain. And, we heard in the plenary session a lot of examples of all the different uncertainties. Just to quote a few examples, the geopolitical risk in the last couple of years has almost gone up 90% from the past. The level of inflation that the Western world is seeing today, they have never seen this in the last 40 years. The world is expected to consume more data in the next 2 years than it has over the last 20 years. And climate risk is here and now. We are seeing more frequency and increasing intensity of events linked to climate risk. And, all of us have to act on it today. In this backdrop, the banks around the world have seen a very structural change in their profitability. What this chart shows you at the bottom is if you take profitability and valuations of global banks around the world from a period before the global financial crisis in 2008, they have lost over 60% of valuation. In that context, the Indian banking industry has truly been a North Star. It has been resilient. The profitability levels have been quite robust, and so have the valuation levels been. And this is quite important for economy to grow. So the banking industry has done quite well. However, the Indian banks cannot take the performance for granted. As they navigate through these turbulent times, there are 5 key imperatives that I would like to touch upon. Number 1, the future of distribution. Number 2, the digital public infrastructure. Number 3, new disruptive technologies like AI, Gen AI. Number 4, climate strategy. And finally, risk maturity framework. And I'll delve on each of these themes briefly in my presentation. Our research globally has shown the primacy of human touch is critical when it comes to banking. What you see on this page is some well-known digital-only banks, and the data shows that they've not been able to really garner deposits of any scale and size. The average size of deposit that they garner is a very small fraction of what a full-fledged commercial bank is able to garner. And that is because banking is not just about distribution of financial products, it's also about trust, it's about engagement, it's about advice. And a physical presence magnifies and solidifies all of these elements along with digital. In India, banks have been able to establish a large number of channels, both the traditional channels like the bank branch, ATM. You see, even these channels are growing in India, albeit at a slower pace, but there's an explosion of other kind of channels. Internet banking, mobile banking, business correspondence, and increasingly going forward, what we call as embedded finance, which basically means that banking services can be distributed through banks' own channels, but also through partners like big techs, fintechs, and other large ecosystem players. Now, the question that banks have to deal with, that this is a complex architecture. Not only have they to deliver their products and services in a secure, seamless manner across all channels, they have to also think about investments on all these channels and about cost income ratio, because every channel requires investments. Now, India has had one of the very unique advantages of having a digital public infrastructure at scale. And we've seen the benefits of that playing out in various forms like UPI. Now, one of the newest elements of our digital public infrastructure, OpenStack, was the account aggregator framework. It went live 2 years back in September 21. And in the first, I would say 1.5 years, the offtake was quite limited, like any new framework. But in the last couple of months, as you'll see in this page, we are seeing the start of an hockey stick framework. Today, more than 40 banks, more than 100 banks, more than 40 AMCs, insurers are already part of the account aggregator framework. And what this means is a lender, with just a simple click of a consent by the borrower, can get access to very rich data, not only the entire transaction data of banks, but also investments in mutual funds, stocks, insurance, and very soon, even the utility bills like electricity, telecom can all be accessed through account aggregator. Now, this can actually create a kind of revolution we saw when we first had our bureau set up in India, right? And then we saw the entire retail credit, SME credit take off. Can this be the next set of evolution? But for doing that, banks will have to reimagine all their functions. Now, let me take an example. You take a small cloth merchant somewhere in a small town in India. Historically, most of these merchants would not get access to formal credits. And even if banks tried, they did not do it in a manner that was economically viable for banks. And the large part of the reason was that there was very little data that a small merchant could generate. But that is changing quite rapidly. Today, this small merchant has an Aadhaar card. He has a QR code in his shop, and he accepts digital payments. He has a bank account where all the digital transactions flow in. Very recently, he also has taken a life insurance policy, and he's paying his premium some time, and also started investing a little bit in stocks. Now, all of this data today can be accessed digitally by banks or by NBFCs to give loans. And they can design products that are cash flow based and that can tailor the needs of this particular small merchant. But that will require banks to think about data governance, right? If they get this data through the consent, how are they storing the data, in what shape and form, and for what purpose? They have to also think about end-to-end digital journeys and a complete reimagination of their underwriting process. Coupled with the digital public infrastructure, banks also have the power now of new technologies like AI and Gen AI. Quite often it's been discussed, what can AI and Gen AI do? And a simple way to understand the power of AI, Gen AI is to imagine a human brain. The traditional AI is like the left part of a brain, more analytical, more predictive, and Gen AI is like the right side of a brain, which is more creative. It can generate content. But if you bring both of these together, then magic can happen. For example, if banks were to do personalization, it can use traditional AI to build models using all the data that we just saw to create the next best offer, but then use Gen AI on top of it to create very vivid content in text, in multimedia, and then it can be used to communicate with the end customer. The question is, how do banks really reimagine a lot of their functions using these disruptive technologies? Moving on to climate, I think I talked about climate risk is here and now. We've studied the entire portfolio of Indian banks' exposure in terms of loans, and we feel about 50% of loans are to sectors that are vulnerable to climate change, right? And the amount of financing that's required just in the next 7 years for green transition is immense. It's more than $2 trillion. But climate change and climate transition is a very complex topic. If I take just one example, this is an example of oil and gas industry. There are large number of technologies that can be used to reduce carbon footprint. Some of them are already viable, like for example, biogas, renewable energy. It's viable today, but it has not been used at scale. Now banks have to think about how to underwrite if they have to give a loan to this particular sector, but also how to educate both their own workforce, but also the companies that they go and serve. But then there are many, many new technologies that are still not viable, but they could hold immense potential in the future. For example, green hydrogen, right? Carbon capture. Now, what can banks do? It's difficult to go and lend if a technology is not yet viable today, but maybe they can think about alternate mechanisms. Think about a venture capital funding. Think about some kind of a green bank carving out of financing for the future if we were to achieve as a country our net transition targets. But then it's not just about large corporates. A lot of money, in fact, we envisage about 60% of green financing will be actually required by MSMEs. Here's an example. Imagine a small merchant who's supplying linen to a large hotel chain, and that hotel chain has made a commitment globally that they want to move to green, and that will also percolate down to their suppliers. And this small merchant now has to both get educated first. What does green mean? What does sustainable technology mean? And then have the wherewithal to be able to invest to create linen in a green manner. And that's where I think banks can play a very, very vital role, not just in terms of designing innovative products, but also actually doing the education for these MSMEs to be able to transition to green. And finally, all of these changes that we're talking about, geopolitical risks, climate changes, and digital all pose newer kinds of challenges and risks to banks, and banks have to continuously evolve their overall risk maturity framework. When we did a study this year's FIBAC, we tried to assess how ready are Indian banks, and we found most of them are somewhere in the middle, and there's a journey for them to travel on this risk maturity framework. So I'll conclude my presentation, and I'll start the panel discussion on some of these topics. So Mr. Khara, let me start, my first question to you. Sir, as you look at all the challenges, headwinds, that you see around the world and also in India, what advice would you have to banks to think about the future risks and challenges, and how should they, prepare for it?
I think we all live in an uncertain world. That's a reality. And when we live in an uncertain world, and while we are having the responsibility of managing the money in a fiduciary capacity, we have to evolve the structures and system which gives us enough insight into the kind of risk which are on the horizon. So when I talk about the risk which are on the horizon, perhaps what you have There are risks which are in the near term, there are risks which are in the medium term, there are risks which are in the long term. Well, in the near term, the risk could be ensuring that the quality of the loan book should stay healthy and the bank should be in a position to navigate the interest rate risk well. Again, this is a function of the ecosystem. Do we have structures and tools available for hedging the interest rate risk? It differs from economies to economy. And at the same time, when it comes to the kind of competition which is also emerging, what is the kind of resilience of the banking system vis-a-vis those players who are emerging on the competitive landscape? But very important is for any bank, and more so I think it holds good for a country like India, which is predominantly banking-led economy. The quality of assets is very important, which means that the underwriting principles and ability to ensure that there should be effective control and oversight on ground. This is very, very critical. And in this context, perhaps, if at all we can take example of India, the ecosystem has certainly evolved, and that has helped in terms of profiling the customers better, or at least validating the balance sheets even better. So I think this is something which is very positive, and that is one of the reasons why perhaps we get to see much better balance sheets in the Indian banking system. But when it comes to the medium-term risk, to my mind, the risk which is looming large today, I would say the medium term, the other very important risk is all of us, all banks are dependent upon various vendors in terms of providing various services, including IT. The strength of any bank is the strength of each of these vendors, which very clearly means that, of course, banking system is subject to a very strong regulatory oversight. But all the players in the ecosystem are perhaps not subject to that kind of oversight, regulatory oversight. So it becomes very essential for the banks who are consuming these services to have some kind of an assurance function in terms of their resilience, their integrity. If at all there is any challenge on these two counts among the ecosystem players, the banking system becomes vulnerable. So this is the other near-term risk which I feel that we as lenders, we have to keep in mind. And when it comes to the medium-term risk, to my mind, that is the transitioning risk. We all talk about the climate risk. You have also talked about it in an abundant measure. But I think to my mind, where we stand today, we'll have to start thinking in terms of transitioning from the fossil fuel to alternate fuels. And in that process, one example I would give is that FGD, which we are insisting for various thermal power units, how to finance it, how to make it a acceptable proposition in the mind of the group of borrowers. Because unless and until they get finance which is reasonably cheap, the adoption will be delayed, which will lead to the delay in transition. And I think that we have got a challenge in terms of the time for transitioning. That is something which you have to keep in mind. And how do we ensure that we continue to have one, buy-in from the industry for transitioning, and secondly, we should have the sources of finance, sources of funding which are cheap, which could be with the help of various multilateral bodies. But we all know that climate finance and the transitioning finance, there was a huge commitment made by the developed world. But unfortunately, they are unable to honor their commitment because of the situations obtaining in those countries in the current scenario. So I think to that extent, we'll have to probably dish out ways and means through which there could be some kind of a cheap source of funds available. To that extent, we also look at the regulators, if at all they can give some relief when it comes to maintaining CRR, etc., so that we can cut the cost of funds which we have. Or alternatively, for such kind of financing, can there be a lower RWAs? This is the other thought which I have in mind. And the last, of course, which is the most important, which would be not in the near term, but yes, in the medium term, is the climate risk. We have to deal with that because climate risk we have already started. See, we have been seeing climate risk in agriculture, but now it is getting much more pronounced. And I think increasingly, as we move forward, the climate risk is going to be very, very significant in the days to come. And for that climate risk also, then of course, we have seen that, the newer avenues which have emerged in terms of the renewable energy financing. So these are the kind of avenues which have emerged. But yes, to ensure that there should be a greater adoption of these newer resources like the renewable energy, EVs, batteries, battery storage. So I think it's a highly complex, because considering the fact that we'll have to scale it up in no time, and we have to have the base power also in the country. Any power plant, thermal power takes at least 5 years. We have not invested. If at all industry starts growing at the kind of rate which you are expecting at about 8%, I'm sure we will need solution ASAP in this particular context. And that is perhaps one of the reasons why when it comes to the IBC, we have seen much better value coming for those stressed thermal power plants. That very clearly is a reflection of how the industry is perceiving the growth and the consumption of the fossil or this power, which would be the base power. Though we are seeing rapid increase in the renewable power in the country and also adoption of EV in a very big way, but I think we probably need to step up on the pedal and go for much faster adoption of renewable energy. And also, while we are doing that, we have to keep in mind the transitioning processes also, so that FGDs kind of things should be adopted in a very big way, so that emissions should be reduced. Unless and until emissions are reduced, we have a challenge. So these are some of my thoughts, initial thoughts.
Thank you, Mr. Khara. I think
a bit longish question, answer to your small question.
I think you've touched upon a large number of points, both short term, medium term. And I'll pick on some of these points, but I just want to move on. The topic is winning in uncertain terms. So we've talked about uncertainty. I want to focus on winning. Let me, come to you, Mr. Vaidyanathan, on the winning theme. As you look at all the changes that are happening in the landscape, are there newer segments that are emerging, for banks that become, viable business models for banks?
See, all of us know that whether in the lower income segment, middle, upper income, everywhere in India there's opportunity, and everybody's building business around these. But one segment I'm beginning to see off late in the country for the last maybe 4 or 5 years is this, this economy or number of jobs coming up in the platform economy, the gig economy. People who are, in every sector, whether it's logistics or, healthcare or delivery or e-commerce, everywhere there is one large category of people getting created there. I was reading a Niti Aayog report which said that there will be 32 million such people in the next 4 or 5 years. Now, for this profile, 32 million is a large base. People have not actually yet discovered who they are. If somebody is lower income profile, it's lower income. If somebody is upper income, but this profile is a new emerging profile. They are neither well paid nor they are terribly underpaid. neither are they highly skilled, nor are they exactly underskilled like a laborer or a mason. Neither are they highly educated, MBS, etc., nor are they really undereducated. So there is one middle that is getting created in India at this point of time, which can be a large middle. It is coming because of either migration or, but that is a large middle coming up in India. I think people have not yet figured out how to deal with them because there's some in the center. If you bank with them, you don't know if they'll get large deposits or not. If you lend to them, you're going to lend them unsecured credit, which will have its own complications, unless it's really cash flow backed. So that is, their investment ticket size are really very small. Their insurance tickets are small. So that is one segment coming in, and that's really an important segment in my opinion. The second emerging thing I see is that with the new, prosperous, economy getting prosperous and people going up the pyramid, I find many new jobs coming up in the country, which are new jobs, which you cannot categorize them as a Cat A, Cat B, Cat C company. That's how all banks do. Okay, Cat A company, I give you 10% interest rate, Cat B, I give 11%. That's how they talk, right? But they are not belonging to any other category, like dog groomers. People are having pets because they can afford it. There's somebody who comes and, carries a pet around. There are, somebody comes, what do you call the people who cut, who trim your nails and all that? Manicures, right? All the people. So they are the new generation people, beauticians. There are really somebody once told me that they organize dog parties. Dog ka birthday party bhi hota hai, but hota hai. Some people are doing it. So the new set of jobs getting created in this country, which are exactly in that category, that also is really, but by the way, they're earning reasonably 40, 50, 80,000 a month. So these are new categories coming up, and I think our models have to evolve. If you have time permits, we'll talk about that, about how they can be quasi-physical, how they can be quasi-digital, how they marry the two to actually bring them into the banking circle. That's my quick thought.
Yeah, I think a large number of new segments coming up and different ways of serving them. Moving on, Mr. Goel, PSU banks still kind of account for bulk of our banking industry, and it's quite heartening to see the PSU banks have done so well over the last couple of years. But that was always not the case. The PSU banks went through a very difficult cycle. How do you see the prospects, going forward, and what has been the learning, and how do you ensure that these banks can continue to participate, in the growth of the Indian economy?
Ruchin is a very good question also, and Kharaji has already told we are already living in the uncertain world also. So as you have told, key profitability definitely everybody knows. Even in the inaugural address, key profitability of the bank is increased manifold, more than 1 trillion in the last financial year of the public sector bank. Then first we have to see what is the parameter of the profitability. There is a lot of parameter, but I will touch only one point because interest rate has been also been addressed by the Kharaji as well as the governor also in his speech. Ki last 1 year, more than 1 year, 250 basis point was the increase in the repo rate. So we are having liability side product, asset side product. What is my belief? Ki if there is a increase in the interest rate, the transmission of the interest rate in the asset side is more quickly as compared to the liability. Because all the loan which is linked with the external benchmark, they have been repriced immediately. Even the loan linked with the MCLR will be repriced maybe in 1 year itself, normally. But only the liability side, if you see, that is not repriced immediately. So that is a one risk, which I am perceiving. So we have to see how the impact will be on the NII. Even in the last quarterly result, we have seen some of the bank, the growth in business is there, but NII, there is an impact. So first we have to do that. So there should immediately, we should thought ki if there is a pressure on the NII, then we have to see the other avenues also to remain the same profitability. So other income will come in the place also. So I am not going detail because it will take too much of time. Everybody knows ki what is the other avenues, ki then non-funded, non-interest, TP, a lot of things is there. But I will tell some of the points which I think apart from the NII also, how we can be agile in the, even it can increase further also. Because scenario is very good. If you see the growth angle, etc. also. So first, I think organize the structure. Then organize structure, then I will divide in 2-3 part also. Ki digital transformation, as on it, which is very much needed. Then we have to make the investment in the digital to make the product in such a way which is convenient to the customer, point number one, and the right price also. Second, maybe when we are talking about the digital, there's some process we can do the automatic process, like opening of the account by biometric, whatever it is. And third, very important is the data analytics also. By making the use of the data, we can increase our business also. Because why I'm telling, because even in the, as Kharaji has told, market is very competitive. If there is no much demand of the credit, so all the very good customer, maybe AAA customer, they are asking for the reduction in the interest rate. So definitely every bank has to take the call, whatever the interest rate. So data analytics, definitely we can create the use of the data, and we can create the lead etc. Also, the second point is the HR transformation also. HR transformation, my view is the role-based recruitment is necessary, because we are talking about the cyber security, we are talking about the risk management, so that should be. Then second, the innovative pay structure also is in need of the hour. And third, internal training also, whatever the human we have taken, the internal training is also much needed. And another point is we have to move from the transaction banking to different banking, because transaction banking we are debit credit. So we should try to market the product by using the transaction to cross-selling etc. also. The another, definitely for the customer service, we can talk the relationship management, then we can add the CRM solution also, because now customer do not want, and the customer want 24/7 working as on that NFT, RTS, that is available also. And we can think other product when we are talking about to increase the profitability. Wealth management, we can think whether we are not providing wealth management to the NRI, even for the operational part, where cash management is also one of the area. The another important thing in the banking basically is how to mitigate the credit risk. So how we can improve the lending by taking the, because fintech companies available, lot of information is available now. Balance sheet we can verify from the MCA, GST what is the turnover. So there is a lot of opportunity available to manage the credit risk also. Then another is the EWS also, because the Anni Valni Singla, they will give the idea also. And one important more thing also, apart from this, collection efficiency. Because ultimately, if you see the more than 60%, 70% on the asset side is the credit. So we have to concentrate on the credit. How can we improve the quality of the credit? How we can monitor by using the platform available? And third, very important is the collection efficiency. Collection efficiency, if you see in the NBFC as compared to the banking sector, everybody is aware. I'm not telling you, even the IDFC mein inka better hai, public sector banks. I used to talk with Nathan, how you advise, what is your collection mechanism? So because they are also doing the personal loan, that only the model can work. So this is my initial thought, because profitability mein, if I will chalk out 1, 2, 3 points, it will take 2 to 3 hours. So I have tried to sum up this is the main point which definitely we should consider to remain the agile in the market. But profitability will definitely increase. Banking sector is performing very well. This is my concluding remark.
Thank you, Mr. Goel. Just moving on, Mr. Dave, we talk about the Indian economy moving from 2.5 trillion to 4, 5, and then beyond. What kind of role do you see foreign banks can play in this evolution of the Indian economy?
Sure, but if it's okay, can I just talk about some of the risks? I also think, maybe.
Please.
I think while digitization is obviously great from a consumer experience, the ability of banks to handle volumes, but I think just the governor encouraged all of us to do more stress tests. It is today the slightest of rumor about you, okay, could be true or could be completely false, and we saw that in the case of the US situation just 6 months back, right? Money moves out overnight. 100% of our deposits can move out overnight, right? So that's, or it could move out on a Sunday where you don't have access to any funding except central bank funding. So I think risks of this nature didn't exist as recent as, 3 years back or 4 years back or so, right? So, and the other thing is social media. I don't think, frankly, financial organizations will ever work at the same speed as the social media does in terms of spreading the adverse news. You cannot get the count. So I think that's one. I think we saw very recently, I know the cyber risk got mentioned, but we had a real incident, right, where one of the largest banks in the world was not able to do basic activities like buying and selling of securities in the US market. They had to go back to Excel, all the way back to Excel with dongles and things like that. So, or a very large port in Australia. Again, a cyber attack, they just could not move containers. I mean, I highlight this to say a lot of work even in banks now doesn't actually get physically signed off by a manager or an officer or a general manager. It's just we've embedded lots of algos, lots of rules, lots of pre-approved things. If A, B, C, D is in place, the money leaves. If somebody changes that A, B, C into A, B minus C, the money will go to somebody different, and you are on the hook. So I think technology is a great enabler. We must support it, but I think as financial institutions, we'll need to be, we are naturally trained to be credit risk managers, but perhaps technology and digital and all those risks. I think I just thought, and same thing even on the geopolitical side. I think you mentioned it, number one. We normally, when we lend, we don't really go through the supply chain of the customer or the end buyer chain. We wouldn't have seen how many of our customers have buyers in Ukraine or Israel right now, or a country with where the default. So I think that's the other thing, that your customer is in good shape, but if the nut which goes into the car comes from a particular country which has got shut off, the car is not produced. And if the car is not produced, your money is at risk. So I think we will also have to learn as an industry. I just thought these three things. But coming to your question on international banks, see, I think if India is going to achieve, and I'm sure it's not a question of if, it's when we will achieve the 4, 5, 10 trillion dollars. Let's face it, it is not going to happen by Indians selling to Indians. Okay, we just don't have the per capita income in the foreseeable future. We will have to make goods and services that are consumed by the rest of the world. Okay, that's part one. If that is required, then you require international banks to support through, for example, if an Indian, let's stick to bolts or nuts only, is selling something to somebody in Mexico, what is the credit risk of that Mexican buyer? What is the credit history of that Mexican buyer in dealings with other exporters? Who are the other buyers of that nut in Mexico? Which are the other sellers? See, these services are difficult for a domestic bank to provide because it's domestic data they have, international data. So one is that if India is going to achieve its ambition, it will happen, I am convinced, through selling more to the rest of the world, goods or services. Clearly, international banks will have a reasonable market share in that, right? That's one. Second, the economy also depends a lot on just simple things like education, right? We now know that there are more Indians who go to study in US than any other nationality. Somebody has to enable banking services. It sounds like a small thing, but the maximum number of calls I get is actually from worried parents that my child is going to UK, Indian parents being Indian parents. He only has $5,000, they tell me. I tell them $5,000 is a lot of money, you can survive, but they all want a credit card on arrival. They want banking. And without banking services and credit card, it's difficult to imagine how you could settle down. So through the softer route of this nature, but equally importantly, I think you look at any large Indian company that's got significant expansion plans, it will require significant either export markets or CapEx, or for example, let's, Air India, right? When it buys the first 2 new planes, somebody has to finance it, right? I mean, in this instance, it happened to be HSBC. That's why I'm taking that example, of course. But the role is very similar to what domestic banks will play, but the parts will be depending on where we can add more value than domestic banks.
Thank you, Shitabe. I think some of the points you touched about in the risks, you talked about digital cybersecurity risks. Mr. Khara, you also spoke about all the banks depend on vendor ecosystem, right? And what happens if one of those systems has a risk? I think the question, and I'll maybe Mr. Khara first is, as we become more digital, the reliance on some of these companies will continue to go up, right? What can be done as a system, as an economy, to ensure that we have players that are more credible? There was some discussion on should we create a shared utility, or should there be accreditations, or should there be more regulations, so that we can have players who can serve banks, but they are also robust and resilient. The way banks are subject to regulations, these players also can be. So any thoughts, sir? What?
Yeah, particularly when we have got a responsibility of ensuring that the channels are up and running 24/7 by 365. So naturally, when it comes to, one is, of course, conditionalities which are prescribed in SLA, but unless and until those SLAs are subject to the ground level testing, and also enforcement and management of those SLAs becomes absolutely essential. So that is, I think, that is something which has been done. But yes, of course, I think these kind of risks are emerging almost on a go, because it is not merely the SLA, it is also a fair assessment in terms of the capability of those service providers and also their governance mechanism which is in place. So actually it is at the time of when we are onboarding our partners, we always look at it, do they have the capability and the resilience which is expected by the bank, which is expected from the bank, and likewise bank also expects similar kind of a resilience and integrity of the processes and systems at their level. So actually that is one of the reasons why what I mentioned, it's a time when perhaps though there may not be a regulator in place for such kind of service providers, but eventually that assurance function has to be done by those who are buying those services. Or alternatively, there could be some certification agencies, third-party certification agencies, which can come up and give an assurance to all those who are consuming such services. To my mind, this is the way we have seen the evolution of the audit function. I think this kind of an assurance function is going to be very, very critical, more so when regulators are expecting financial institutions to ensure that their vendors should be 100% reliable. So that is possible. Initially, it will happen by the larger institution getting into the assurance function, but eventually, I believe those independent certification will become the way forward.
Thank you, Mr. Khara. Just conscious of time, maybe a couple of questions more, and if there are any questions in the audience, I'll try and take one or two questions more. Mr. Radhanathan, the way our digital public infrastructure has been set up, and banks have so many different avenues in terms of channels to use to distribute their products and services. Yet we see the physical, branches still kind of growing in India. What is the end game here? I mean, as a country, where do you see 5-10 years down the line the distribution of banks look like?
See, 10 years is a very long time, but let me just give a more near-term picture. See, to think that when you go online, whether it's account opening, giving loans, investment advice, everything, oftentimes there is a last element of a physical leg that is often required. And to connect the two seamlessly is where really powerful things happen. For example, I was reading up about the medical industry. So they said that, look, doctors are available on call. Okay, somebody put up that capability and all that. But when doctor is messaging on call, they're also checking your blood pressure. They're also checking your pulse. Now, how you're going to show the pulse to the doctor? Okay. Now, therefore, some fintech has now come up and said, here, listen, or some technology firm or somebody like that is now setting up physical beds where people can come and then they can show the pulse and then doctor can advise. So they're seamlessly merging the two. Now, this is happening in banking also. This is happening elsewhere also. So the very important thing is that how do we put them together is one important thing. We think about it all the time. Second thing is that there are large number of digital public goods. We know that. Okay, we know all the well-known ones, whether it's Aadhaar or and the credit bureaus, and there's so many digital goods, UPI and all that. Now, as a bank, we need to connect with all of them. That's first requirement. Now there are new digital public goods coming up, which are not even those well-known ones. For example, account aggregator is coming up. It's a new digital public good capability that's coming up. DigiLocker is a new capability that's coming up, which is not part of the original stack. Now, as an organization, to your question, we need to be in a position to connect into all these ecosystems, all the important ones, Otherwise, all these terms are just general theory for us. अच्छा ये हो गया digital public good अपने को lecture थोड़ी देना है. The thing is that we have to connect, we have to make them, we have to utilize them. So we have to connect. For that you need API capabilities. Then after you connect, then you need to do something with the information. For that you need a data capability. Because after all, without a high quality data capability, what to use all the goods? Then after using data, then you need to have all this personalization, hyper-personalization, all these technologies have to work. Then after that, you have to present them at presentation layer. So the whole stack of being able to connect, to use the data, the technologies, and the let me say, the presentation layer, they all have to come together to get maximum value. I can tell you at our bank, we're thinking about these things all the time. For us, this is not general Gyan models. So this is something to really work with. We believe we can reach large number of segments. Like Goel Saab said, our collection capabilities dramatically goes up. If we build this up, our ability to reach customers goes up dramatically. Our ability to meet customers' requirement goes up dramatically. We have to respect the customer's time. So therefore, to give meaningful tips and recommendations to the customer, not generally spam customers. All these powerful capabilities come up from this whole capability.
Thank you. Just, conscious of time, I just open up, the floor for any questions any member in the audience has for any of the panel members. So if you can just stand up, if you have a mic, just take your name and ask the question.
Yeah, good morning, sir. In the morning, we heard our honorable governor about, the young Arjuna being able to balance both the fish eye, looking at the water. So obviously, our central bank has done an outstanding job steering us from 1992 up till today. But worldwide, in the Western hemisphere or even on the eastern side, the central banks have not really been able to do a fantastic job, whether it comes to financial stability or managing inflations or containing crises. So there is a school of thought which is coming, are the central banks really required? Cannot the largest banks in the respective countries play the role of central bankers? And the second thing is that the decentralization of finance is happening, and one of the applications is obviously digital currency. Going forward, how successful the central bankers are going to be able to either stop the creation of a parallel economy or take advantage of the parallel economy which will get created, going back to the days of bartering.
There was a point of time when the largest bank of the country was actually performing the role of the central bank. It was before 1935. It was Imperial Bank of India which was performing the role of Central Bank of India, Central Bank of the country. Now, your question whether central banks are required, I think they are very much required. Particularly when you are dealing with the money of very large population of the country, there has to be an order. And there has to be somebody, because those fiduciary capacity, there has to be a central banker who should be in a position to watch the interest of such large population. That is one. And secondly, of course, in the current situation, it is inflation targeting is something which has been one of the major objective for the central bank when it comes to the monetary policy. And what we have seen in the most turbulent times in this economy, it was perhaps the maturity of the central bank, which could see that the Indian economy sailed through harmlessly. And there are examples across the globe what actions were taken by various central bankers and how it resulted into the damage to the economies. So I think I'm very convinced that the central banks have got a role to play, and it is not merely central bank, there is a need for regulatory in all sectors. And that is something, as the economy evolves, as there is more freedom given to the players, there has to be somebody who should act as a referee and umpire. And that is nothing but the central bank who can perform that role. Otherwise, you can very well imagine what will be the situation in the play field also, if at all there is no umpire. So that's one thing. Your second question relating to CBDC, on that I would like to say, that if at all there is a currency, somebody should stand by it. And that sovereign guarantee is nothing but this, it is offered through the CBDC. All of us have seen what happened to crypto. So I think, again, if at all there has to be an order in the economy, the CBDC is perhaps, it marries what is there in crypto, but at the same time, it ensures that there is a confidence. If at all something is known as currency, there has to be a confidence, and that is something which is guaranteed by the central bank.
Thank you. So if I can just ask a question briefly.
I am KK Gupta from Research in India. We are talking about uncertainty times. So after coming artificial intelligence, even fintech company, whether it can be a threat to the bank.
I think we have to change our mindset also. Earlier we used to say ki if a fintech company is coming, they are the competitor to the banking industry. But now I think in any factor, forget about the AI, the role of the fintech company is the collaboration. We should make the collaboration work. I do not find any threat in any fintech company.
Also, if you notice, AI is everywhere. Now, of course, a new generative form of AI has come, which is also another level of capability, of course. But you should see this as an extraordinary means of making things happen, capabilities. Today, for example, if customer is sending you a mail saying with a particular problem, some human being is picking it up. Some human being with a limited ability of seeing on the screen is giving some response and solving some problems. Tomorrow, if the same thing is plugged into a proper high-quality generative AI, then the same question, it can go into your whole system, prepare a very appropriate response. You can go into your systems, do the calculations, submit, like how you go and get something in ChatGPT today or on Bard. So the quality of conversation to customers and the service you can provide can all dramatically go up in this one small example. And then you take it up from there, from that point of view, and then you give it a face or give it a voice. Then you can even have a human bot speaking to customers effectively, as effectively. So these are real capabilities. We should actually see these as opportunities.
Maybe one last question if somebody has in the audience. All right, I'll bring this discussion to a close. Just to summarize, we spoke about winning in uncertain terms, and there were many risks, both short-term, medium-term, long-term. That of course, the economy and hence the banks face. But also there is a clear appreciation of what India has done and the regulators have done in the past with even more, dramatic events that we've seen in the past. So there is confidence that the banking industry is resilient and there's a lot of opportunities. All the technologies, while they pose a threat, they also present tremendous opportunities for the future. I think on that positive note, I'll bring this panel to a close.
And also the person who asked the question of central banker, don't forget the case of Sam Bankman-Fried, right? Don't forget that case. You should.
Thank you. Thank you so much.
Thank you all dignitaries. This session has enlightened us on how Indian financial industry continues to be the world's envy during uncertain time. Our panelists have left no stone unturned by sharing their deep insight that has added immense value on the topic. Thank you, dignitaries. Dear all, we will take 5 minutes to change the dais. Before we start the next session, may I request everyone to please be seated.